Hey guys, welcome back to the Graham Strategy channel. I start by reminding you that I'm not a financial advisor and I do not make any recommendations on what you should or should not buy or sell. It has been an interesting and somewhat turbulent time in the financial markets the past month. The inflation stays high and the Fed is now talking about raising interest rates much earlier than previously stated in order to try to curb the inflation. I've been expecting this for quite some time now, as continuous money printing has always led to high inflation, and this time is no different. We start this video by taking a look at the portfolio, how it has performed the past month. Then I will show some charts that explain how the Graham strategy can perform so much better than the index over time. But first, the portfolio. We started on March 5th this year and has since then grown 50.26%, which is 4 times that of the OM index or 400% of the index, which has gained only 12.56%. This is a truly remarkable performance of the Graham strategy. Next, let's have a look at how compounding interest can be such a powerful tool when you have good yearly returns and lots of time. Many people want to see quick results and they tend to be risk-taking, which makes a lottery seem like a good option for them. They want to bet $10 and win $1 million the same day, which can be very attractive for some people. However, these people tend to stay poor as their investment strategy rarely shows any gains. So let's start by looking at historical data for the Graham strategy. If you want to see more examples of this, check out my first video. This data series starts in March 2001, which is after the IT bubble burst and the stock market was still falling for another 2 years, which means for the first couple of years the return was small and at times negative. In 2003, the Graham strategy fell by 26.3% and the OMX index by 40.6%, which means for the index fund investors, half of the investment was gone after 2 years. Looking at the blue and red line in the yearly return chart, where the red is the return of the OMX30 per year, and the blue is the return of the Graham strategy per year. And if you compare them, you can see that the difference seems quite small, seems more or less identical. So why would there be a difference between those two strategies? If we look at the capital gain chart, we can see that the choice of strategy makes a huge difference. $1,000 invested in the index fund has only a little more than doubled in value over 20 years, giving a mere $2,175, while the Graham strategy has gained more than 28 times the initial investments to a total value of $28,640. And this was with a really bad timing for the initial investment in March 2001 when the stock market was still falling. When making the calculation with a fixed yearly return, the difference is obvious in this chart. Here you see that we have 18.3% return with the Graham strategy and 4% with the OMX30 index. And this is if you started in March 2001. You see the capital gain here reaches about the same levels as in the previous charts. But if we add a little bit higher return, let's say if we started this in March 2003 instead, then the Graham index would have returned 21.7% per year and the index 8.5%. And both strategies would have given a better return, and you see that the capital gain is higher, but still the Graham strategy performs much better with a return of $50,794 for $1,000 invested, and the index only $5,112 for $1,000 invested. So that was all for today. Stay tuned for updates on the portfolio, subscribe and hit the notification bell to receive updates when I release a new video. So until next time, as always, stay sharp and follow your passion.